Hello everyone and welcome back to the channel. My name is Smart Money Mo, and in today's video I'm going to be teaching you the number one confirmation that you should currently be using. I'm going to explain why it works, how you can use it, and I'm also going to be giving you guys a very good example of it in use on the real life charts. Now before we get into that, I just want to quickly mention that I am currently accepting new members and new students for the mentorship, and we have a full course, the full ALQ strategy with proven results of a average 3.5 RR and a 50% win rate, which would make you in turn very profitable. Signals, which will be returning in September. Results such as these, past FTMOs, past equity edges, and past accounts. And yeah, that's just a quick guide for that. And if you want to get involved with the mentorship, make sure to click the first link in the description for all the details and to purchase it. But without further ado, let's get right into today's video. Alright everyone, so let's start off with why does this confirmation actually work, right? What is the reasoning behind it? Because a lot of the educators in the Forex industry, they don't like to give you the explanation or the logic behind why their strategy or whatever works, right? They just tell you use it and just take my word for it. But now, what I'm going to do is I'm going to teach you why this actually works. So, first things first is you need to understand this confirmation is based off of the failure of supply and demand. And the reason why this works as a confirmation is because we know supply and demand is what moves price towards its desired location, right? So let's just understand this better on this diagram. Here we have a very clear bullish trend, and we can see this bullish trend is moving towards the upside because it's respecting the demand zones, right? We can see price is respecting these levels of demands. We're not breaking through them. We're not disrespecting them. We are moving towards the upside because price is currently respecting the overall demand zones, and that is what is moving price towards the upside, right? So this is going to be important for later on, because if price fails a S&D zone, supply and demand zone, in the opposing direction, then we know that there is a market structure shift, right? Or a shift in the structure, right? That's why you might see the abbreviation SIS in my charts, because this stands for a shift in the market structure. So what do I mean by that? What I mean by that is, let's say now, we're respecting these demand zones, tick, tick, tick. Now we're expecting for price to respect this demand zone over here, right? But then what happens? Price comes down, it disrespects this demand zone, so we go and we trade below this level. So this is important because previously we have been going up in price, breaking structure, breaking high after high after high, because price is respecting these demand zones, and that is pushing price upwards. We mitigate demand, we push up. We mitigate demand, we push up. However, here we go to a demand zone and we break through it. What does this tell us? This tells us that we're going to see a shift in market structure, as previously we were seeing that price is respecting these demand zones. However, now we can see that price disrespected this and failed this demand zone. Therefore, this is our confirmation to go shorts, right? And we don't use this confirmation alone. This confirmation is used when we have a sort of higher time frame indication or bias telling us that we should be going shorts. So let's just say, all the way back here on the 4-hour time frame, right? There's some, I don't know, some liquidity that gets swept like right here, right? This is where we're going to use the confirmation. We're going to use this confirmation as an indication that our higher time frame 4-hour bias is correct, and therefore we should be shorting on, for example, the 3-minute time frame, right? And so yeah, this acts as a confirmation for our trade, allowing us to take an entry even if the market trend is against us. So what I mean by that is, let's just say the market trend is against us. So we're currently bullish in this example, right? And let's say we have a 4-hour bias telling us that when price reaches this point, we're trying to see some shorts. So after price breaks through this demand, we have our confirmation for shorts. And even if the previous trend was bullish, we can scratch that off and we can think, now we have the confirmation to go shorts. So guys, that is the explanation as to why this confirmation works. What we're going to quickly do is we're going to move on to the actual process as to how to implement this confirmation into your chart, and then after that we'll move on to the real life chart example of how to actually implement it onto your charts. So I'll see you guys in just a sec. Alright everyone, now that we understand the reasoning behind this confirmation, let's actually go through the steps to use this confirmation in your real life trades and whatnot. So the first thing you need to understand is you need a higher time frame bias of some sort. That can be a higher time frame liquidity sweep, higher time frame supply demand zone, whatever it is. Let's just say in this example, right, if I extend price, you know, like this, let's just say right now we're on the 3-minute time frame looking for an entry, and our higher time frame bias is that over here price tapped into a 1 hour supply zone. So where this high is, there is a bigger supply zone which price just tapped into, right? And that is our high time frame bias. So next, what we need to do is identify the supply or demand zone that we expect for price to fail. So in this case, because we're looking to go short, as that is what our high time frame bias is telling us, we can say that this demand zone over here is what we expect price to fail. So we can mark up this demand zone and we can say, yep, I expect after price fails this demand zone for us to go shorts. And that is exactly what we do. So we mark up this demand zone. As we know, this is the movement of price towards the upside. And once we see this fail, we can say that happily that there is a shift in structure. So we mark it up, we wait for price to fail it. As we can see here, price drops below it and it breaks through it. And if we're on the 3-minute time frame, I would prefer a candle to close below this demand zone to tell us that this is a shift in structure. So after we see that, all we simply do now is we wait for our entry either at a fair value gap or a supply and demand zone. And in this case, we will be presented with a flip zone. So if we do end up seeing a supply zone, for example, this one over here, we can call this a supply flip zone, right? That is because this zone created a flip. We flipped from demand to supply. Therefore, this is an extra confirmation as we have a supply flip zone. But yeah, a fair value gap entry is also good enough. So just here, if we had a fair value gap or an imbalance, we can enter from there, entry there, SL at the high, TP at the low. And it is as simple as that. So yeah, guys, what we're going to do is now is we're going to try and apply this 4-step process on a very, very beautiful trade that I took on the NASDAQ, on the NAS 100. And yeah, I'll see you guys in just a sec. All right, everyone, here we are on the NASDAQ 100. And what we will be doing is we will be looking for our higher time frame bias first. And we'll be going through each and every one of these 4 steps. So like I said, step 1 is to look for the relatively higher time frame bias for this trade. And in this trade, I was looking for price to take out this area of liquidity, which is a previous day high. And I was looking for price to sweep these level of equal highs right here as well. And this was going to be my confirmation for this trade. My bias for this trade. So essentially what I want to see is for price to go sweep this level and to go short. So what do I need now? And now I need the confirmation on the 3-minute time frame for this particular trade. So let's see the sweep and then we'll wait for the market, the shift in structure. Okay, so now that we have the sweep, price has swept, we're going to look for our shift in structure and essentially our failure of demand at this demand zone. So that is step 2, which is to mark up S&D to fail. And as we can see in this case, because we are previously bullish, we need to mark up the demand zone, which is going to fail, which is this demand zone right here. We want to see this demand zone fail. What's important about the next couple of steps is that if this demand zone doesn't fail, then we know we can't go shorts yet and we don't have a valid shift in structure. So yeah, let's just play price and see if we get the shift in structure. Price does not shift in structure yet. We can actually see that price respects this demand zone. If I bring it down to the wick, we can see price respects this demand zone and actually starts moving towards the upside. Therefore, we can't go for shorts yet. That's where some of you might have gotten, stopped out, for example, over here, or you didn't get a successful trade, right? Because we don't have the market structure shift yet. So anyone entering from this fair value gap would have been stopped out. So what do? We wait for price to fail now this level of demand. Because we respected this level of demand, now we need to see the latest level of demand. We need to see price fail it for our shift in structure. And that's why this concept is so important, guys. Because if we don't see price failing the demand zone, then we know not to go shorts, right? Because we don't have the shift in structure, and that's why this works, right? But here we can see price fails it, and then we have step 3. Fail SND for SIS. And now we can say we have our shift in structure right here, guys, and we can successfully go shorts on this trade. And that brings us on to step number 4, which is to enter from SND or fair value gap. And as we can see, price fails this level of demand, and we can enter from our fair value gap right here, just about there. And our stop loss can go at the last point of efficient price action. So we can put that right there at this supply and demand zone. And our TPs can go we can aim for a nice 1 to 4 at this level of equal lows right here. So just like that, if you enter this trade on, let's say for example, a 10k account or a 100k account, and let's say we make this 4%, you could have made 4 grand or 400 pounds in this trade right here. And we did that using the shift in structure of this confirmation, right? So this is the new change of character, guys. There we go, we're entered in. And as you guys can see, very rapidly we gain our 1 to 4 risk to reward, and we hit TP. And guys, it is as simple as that. There is no need to complicate your trading, right? You get the higher time frame bias, you look for your new confirmation now, hopefully, in this shift in structure for the failure of supply or demand. You enter from the supply zone or the fair value gap, and you put your stop loss, you put your TP, and you just hit TP, right? So guys, it is as simple as that. Don't overcomplicate your trading and take an element from this guide. But yeah, guys, thank you all very much for watching today's video. If you did enjoy, make sure to leave a like and a comment letting me know. If you're interested in learning more about my style of trading and, you know, more about the way I trade and the signals and the mentorship and all of that good stuff, then make sure you check out the first link in the description to join the mentorship and become a new student and a new part of my team. But yeah, thank you all very much for watching today's video, and I will see you in the next one.